We're now joined by Dr. Keyu Jin. She's the professor at the London School of Economics and Political Science. Thank you for coming back on the program. You've had a chance as well to talk to a lot of people here. How much of a concern is it that this is the starting point of further escalation down the line in a trade war?
Well, I think that pressures on trade is certainly one of the major risks that could also trigger some aftermath, for the global financial markets. And I think that escalation is happening, although that is absolutely not what China would like to see, because China understands that both sides would be hurt very much. And I think that China has made a significant move towards liberalizing some of the financial services when President Trump visited China during his presidential trip. As a way to signal to the world that actually China is going to move away from a global systemic taker to a giver. But of course, these contracts could be reneged in the event of that. And I think that China also faces a lot of political pressure from the people, the Chinese businesses, who would be pressuring the government to stand, push back against the trade and trade protectionism.
I mean, the other major development has been, of course, the consideration that the two-term limit for the Chinese president could be scrapped. Again, a lot of decision makers digesting that. What is your key takeaway from that? Is that more of a worry, or is that more of a benefit because of the concentration of power that would allow more streamlined decision making?
I think that one of the misinterpretations or misunderstanding of China, of President Xi's power, is that it is a one-man show. It is not a one-man show. Actually, it's much more complicated than that. There is a system of balance of power and checks and balances within the party. If you look at the standing committee, it's not all President Xi's personnel. I would say that it is true that the major difference is that President Xi is taking some of the economic power of controlling the economy, unlike any of the other past presidents. But I think that it is a time when China is going through a transition, and where the reforms have not been up to pace or as quickly and efficiently as they should have been implemented is the lack of that, strong power which President Xi has provided. So I just want to give a little bit of a different perspective, is that not only is he thinking about how to create a better system that's more sustainable, not just about one leader, because he wants a legacy that after he leaves, that the system sustains.
Yeah, and I want to pick up on the reforms that you just mentioned, the bad loan issue, the deleveraging process underway. Are they moving fast enough and with the right kind of measures to really fundamentally resolve this problem?
No, I think that the debt issue is slowly, coming into calmer waters. The Chinese government has implemented a series of measures, including cooling down the housing measures, housing bubble, and kind of bring all the regulatory framework under one umbrella, and lots of macroprudential policies are in place so that we see a slowdown of the debt to GDP ratio climb. But I think that one of the things that people tend to forget is, there are a bunch of reasons why a financial panic is very unlikely, not least because there's 70 trillion RMB of assets, and also the ability for the government to coordinate any kind of actor in case there's something that happens. Yeah.
Where does that leave the PBOC? I mean, it's pushing back with its reforms, or pushing onwards with its reforms. I mean, we were talking before we came on air, and you said, look, the reality is you've got all these central banks, they're not coordinating their policies, and that's going to lead to the possibility of policy error, isn't it?
Well, certainly that is a global concern when all the major central banks are tightening, and China is trying to cool down or, level off its, debt, and so tightening liquidity. I think that the RMB is also one of the, exchange rate is one of the considerations. But now that the depreciation of the RMB has, that pressure is a little bit off with the U.S. dollar on a depreciating trend, they have a little bit more wiggle room in terms of greater capital account liberalization, exchange rate flexibility, and also on monetary policy.
There are folks out there who think that the tighter liquidity is ultimately going to begin a process of some of these asset bubbles getting pricked. You don't think it's going to be that? You don't think it's going to be rising rates? You think it's geopolitics that's going to turn this around? I
think it's both. I think that at least 50% of the high asset prices is driven by low interest rates, and the fact that tightening could significantly be a risk for asset prices to decline.